In this video, we're just going to review briefly how you would construct a trade distribution. Really, you want to look at 100 to 1,000 or more instances of patterns in order to come up with decent inferences about what to expect moving forward, and also more importantly, when to know if it's falling apart, if it's not working anymore. What we covered in another video was that you can use pattern structure to come up with targets and entry prices. If you have an entry price of about here on this first pattern in M7 and an exit here, let us say that that can provide you with a 1.5 reward to risk, meaning that your entry is here, your stop loss goes a couple points beyond the D, placed after the market starts moving up, and your target is here at about 62%. Then this first pattern could be said to have been a success. Now this is purely hypothetical. Just looking back at a chart, we're not looking at liquidity factors, slippage, stocks versus forex, whether you are a high frequency trader trading right next to the stock exchange. You're probably not using this software if that's the case. The point is, we're not looking at actual trade results here. We're not looking at liquidity factors whatsoever. We're just looking at prices and patterns that occurred recently in this 5-minute Apple stock chart that are objective patterns which can be identified. On this pattern, let's say that we had a 1-to-1 reward to risk, although it was probably a little bit better than that. And then here on this M7, let's say again that we had a 1.5 to 1. So keeping track of these, we have 3 winning patterns from this past week as I record this in Apple stock. Now we'll look on the bear side. Okay, on the bear side of the market, there's a W10 which came down to at least the 62%, and actually a little bit more than that. And so we could call that a plus 1.5. I'm using terminology, an R multiple terminology, which I learned from Van Tharp. You can think of whatever dollar amount that you use from 20% to 0%. If you risk $10, then by the time you would have hit your target, you would have made 15. So this is probably a plus 1.5. Then you have another W5 here that was shallow. The reaction was a failure. I only made it into the 38 to 50 area and then bounced back up and went a fair bit higher. That is a -1. You might have lost 1 time your risk amount. And then into the close yesterday, we had a W10. And sure enough, this morning we had selling pressure come in, which would have at least hit the 62, if not more than. So that's a plus 1.5 as well. So out of these 6 patterns from this week and at 5-minute Apple stock, that's just looking at one pattern level. You can see that we would be plus 6 times our risk amount. And that is how you could begin to construct trade distribution in your research, because you will want to compile detailed statistics on actual market dynamics, what's actually happening. These patterns are just something that the price action draws out. The interaction of all these market participants must be being driven by something consistent in order for consistent patterns to show up in data like this. There's something behind it that creates it like this. The point is, you can quantify your risk, you can quantify how often prices reach certain targets, whether it's the best price to enter, and you can also quantify how often these patterns actually correlate with tradable market pivots.